So the auditor needs to conduct risk assessment procedures in order to be able to assess the risk of material misstatement. Okay, so how the auditor would do this would be to first of all assess the requirements of the applicable IFRS. Okay, so if you think of depreciation and the useful life that we had previously talked about as being the estimate, just think of IAS 16 that requires there to be an annual revision or an annual reassessment of the applicability of the useful life of specific assets, okay, for PPE specifically. Okay, so the auditor would then assess what are the requirements of the IFRS, the applicable IFRS, and then how management would identify these. So you would have to make some inquiries of management and assess how do they then assess or verify which IFRS is applicable and how do they apply that then. Okay, and then also more inquiries would have to be done with respect to any changes in the circumstances, okay, of the client, okay, of the management specifically, and then how they identify if there is any new information with respect to how the estimate is calculated, okay? Or if there are circumstances that have changed or new circumstances that dictate how the estimate would have to be calculated, how management identify those changes in circumstances, and then how they then implement those in their accounting estimates, okay? So the methods that management use are very important, okay? The auditor would need to gain an in-depth understanding of what methods management actually use, the reasons for those methods, and then how that is then appropriately accounted for in the financial statements as well. Okay, so responding to that risk of material misstatement. Okay, so if the auditor has made an assessment, he's done his risk assessment procedures, and he's concluded that the risk of material misstatement is high, medium, or low, whatever the case may be, okay, that would dictate the nature, timing, and extent of audit procedures that the auditor would need to respond with respect to that risk of material misstatement. Okay, so first of all, he's going to obviously, if management have implemented controls, he would need to then test those controls over the estimates, okay, and then he would make a conclusion with respect to the operating efficiency and effectiveness of those controls, and then he would then assess how that influences his substantive procedures, but he's going to obviously have to do some substantive procedures in any case, okay. So he will have to once again look at the methods, the assumptions that management have used, the circumstances that they have assessed as being key to the calculation of these estimates. So he would then have to recalculate these estimates based on the assumptions that management have used, but also make an assessment of whether the assumptions that management have used, if that is appropriate. Okay, and then he can also use post-year-end information. Okay, so for example, if the prior year estimate for the allowance for credit losses was a certain percentage, you can compare that to the actual current year bad debts to assess whether the previous estimate that management have assessed, whether that has been relatively accurate. Okay. And then also he has to assess the overall reasonability, okay, and then what approval and review processes management have in place with respect to these accounting estimates. Okay. Okay, so ISO 550 covers related parties. Okay. So remember, management are responsible for the preparation of the financial statements. Okay, so the responsibility of the auditor would be to identify related party relationships, once again assess the risk of material misstatement, respond to that risk of material misstatement, and then also assess whether related parties have been appropriately accounted for and disclosed. Okay, not ensure that related parties have been appropriately accounted for and disclosed, because that is management's responsibility, but he needs to verify whether that has actually been done appropriately. Okay, so for identifying the related parties, okay, there are a whole range of things that the auditor could possibly do. In identifying related party relationships, first thing that the auditors or the audit team would do would be to have discussion amongst the audit team, where, for example, the seniors on the audit team would share their list of related parties with the junior team members. That should obviously also be recorded in the working papers, but also to just remind the team and to make them aware of the fact that throughout the audit they should keep an awareness for identifying related party relationships. Okay, and then obviously the team is going to make some inquiries of management, and then understanding how management themselves or the entity themselves, what controls they have over identifying relationships with related parties or transactions with related parties. For example, they would want to inquire from management or obtain an understanding of how or what policies and procedures there are for declaring interests in declaration of interest by management, or where there were, for example, board meetings, and then there are conflicts of interest, what policies and procedures there are in place, how that should be declared, what's the recusal process, and all of those aspects of interests in other contracts. Okay, so they should also just, once again, after they have reminded themselves with respect to keeping an alertness for identifying related party relationships, whenever there is documentation requested, okay, if there needs to be an assessment of whether those transactions has taken place with a related party, okay, so that they are able to assess, okay, identify that this is a related party relationship, and then what are all of the transactions that occur with a related party, and that needs to then be assessed whether management have also appropriately accounted and disclosed those transactions. Okay. So in terms of responding to the risk of material misstatement, obviously, once again, the nature, timing, and extent of the audit procedures would depend on what the risk of material misstatement has been assessed at, okay, whether that's high, low, or medium, okay. But if there are controls, we've already said that they need to assess those controls, whether they operate effectively or not, and then they can test those controls. But obviously some substantive procedures would have to be performed. For example, confirmations of transactions with the bank, lawyers, any third party that would have information with respect to related parties. Okay, the audit team can also assess the annual returns that the company submits, for example, to the receiver of revenue, whether there's any related parties identified, or to the Ministry of Trade, or any other annual returns that the company is responsible for. Yeah. In terms of actually testing the related party transactions or relationships, once all of the related parties have been identified, the audit team would then go ahead and request the supporting documentation for transactions with these related parties, whether it is invoices or contracts. Specifically contracts, then would need to, the audit team would need to assess what are the terms and conditions of those contracts, and then to assess, so that they are able to assess whether that is appropriately disclosed in the financial statements. Where transactions have been conducted at an arm's length, okay, so that means there were no special terms and conditions or favorable terms and conditions with respect to the transactions with the related parties. The auditor can then also compare these transactions, which are at arm's length, to similar transactions which may have been conducted with a third party. For example, if you're renting from your subsidiary, is that a market-related rent? Would that be a similar rent that has been paid to an external party? Okay. The auditor can also bring in an expert, okay, depending on the nature of the transactions, to determine whether the transaction has actually occurred at market value when he is assessing the terms of that transaction. Okay. And then once again, he needs to then, based on the evidence that has been conducted, make the assessment of whether that is appropriately accounted for and disclosed in the financial statements.